Good morning, everyone, and thank you very much for joining me today. It's Tuesday, it's the 2nd of August. My name is Russell Shaw, I'm a Senior Market Specialist at FXCM. My email address is r@fxcm.com. Just want to bring up the high-risk investment warning, and whilst this is on screen, I have set up the link for Friday's live non-farm payroll trade. I'm just going to pop that in the chat. So please join me for that. I'll put the link in. If you have any trouble accessing that link, of course, send me an email. But I do know that on a fair few occasions, my emails go into a spam folder, and then of course you don't realize that I've replied. So if you send me emails, of course, just check your spam. I'm not sure why it does it. I think there's some sort of filter built into Google. Hey Anna, good morning. Nice to have you on the webinar as always. Thank you everyone for joining. And what I'm going to do now is just bring up our market commentaries disclaimer. Hey Katie, nice to have you on the webinar as well as always, and good morning to you. Let's just bring up the references. Yesterday, I did take a long position in the DAX, and it was actually stopped out. Again, no real. The loss was it hit the stop loss, controlled loss, but it did introduce the question of what is going on in the markets, and I did give this some fair amount of thought, and that's what I want to discuss today. We're going to carry on from the discussion that we had yesterday, and of course I would encourage your thoughts as well. Hey Rob, thank you very much, and looking forward to the trade on Friday. All right, let's take a look at let's take a look at the CNBC article first. Let's get that done, and then we can look at the charts. I think what I'll do is I'll just bring up the DAX, and then I'll just sort of let you know my thoughts and why I think we're in a really complex market. So the headline for the CNBC article reads as follows: European stocks set to retreat, tracking global risk-off sentiment. European markets are set to pull back slightly on Tuesday, tracking risk-off sentiment globally as investors assess whether last month's rally has further to run. Shares in Asia Pacific retreated overnight, with mainland Chinese markets leading losses as geopolitical tensions rose over US House Speaker Nancy Pelosi's possible visit to Taiwan. Just incidentally, around that paragraph, if you go into any podcast platform, one of my favorite podcasts, Bloomberg Surveillance, there's a really good interview. It's the first interview on yesterday's podcast with a notable politician speaking exactly about that. I found it very, very interesting. US stock futures fell in early pre-market trading after slipping lower to start the month, with not all investors convinced that the pain for risk assets is truly over. The dollar and US long-term treasury yields declined on concerns about Pelosi's Taiwan visit and weak data out of the United States, where data on Monday showed that manufacturing activity weakened in June, furthering fears of global recession. Oil has also retreated as manufacturing data showed weakness in several major economies. Earnings remain a key driver of individual share price movement. BP, Ferrari, Maersk and Uniper were among the major European companies reporting before the bell today. The first Ukrainian ship bound for Lebanon to carry grain through the Black Sea since the Russian invasion left the port of Odessa on Monday under a safe passage deal, offering some hope in the face of a deepening global food crisis. So that certainly, I think, is very much needed. Okay, let's just run through the DAX trade of yesterday. I'm going to go down to the let's go down to the daily. So there is a strong daily momentum. We're in zone 1, and if you take a look at the hourly chart, so this is what we spoke about yesterday. We were just about to get across. We hadn't quite crossed the stochastic when you and I met yesterday, but perhaps an hour or two later, we did get across. I put in a long position, and then of course I had to cut. Okay, so I had to cut the position. We hit the upper quintile, so everything was looking good. Everything was looking good. And then, of course, we fell out of the momentum zone. And well, if there's no momentum to carry my trade, I don't want to be in it. So I exited, and we will reset and see if we can get into another position. However, let's just go back to the weekly chart here for a moment, and just acknowledge the potential lower peak scenario, which perhaps I didn't really stress yesterday. In fact, yesterday when we spoke, my feeling was perhaps we would take out that 62% retracement, and we still might. I just want to give you some thoughts of potential risks at this point. So the idea here is, are we making the lower peak? And if we are making the lower peak, will we get into another swing down? And all this sort of positivity that we've seen in July will just evaporate. And I actually think that there is a real danger of that. Again, we can't, I don't want to forecast. I just want to sort of give a reason of why I suggest we're in a risky environment, and that I'm sure of. We're in a high risk environment, and that means we've got to respect that risk. That means stop losses, money management. That's got to be your first consideration when approaching the market. So let's take a look at this chart here. Now, I've got a hidden chart behind this, which I'm going to show you. So just ignore, I've got the real rates underneath this. So we're not looking at real rates here. What we're looking at is we're looking at CPR. That's this core CPR. That's this red series here, which is 6.08%. And we're looking at core PCE, which is personal consumption expenditure, 4.79. They both measures of inflation. The one that the Fed focuses on is the black series, core PCE. You can see that they are closely related. It's here. However, they're not the same. So which one is the better measure? My opinion is the PCE is the better measure. And the reason for that is because there's two real reasons why I think it's better. First of all, it's broader than CPR. So CPR is effectively a fixed basket. It doesn't have to be a fixed basket. There's different ways of calculating CPI. I can't remember which one is which, but there's something called the PASCHE, P-A-A-S-C-H-E, PASCHE methodology. There's something called the Las Perez methodology. One of them makes, I think, allowances for substitutes, but I don't think this one, I don't think this red one does do that. So let me just explain what I'm talking about. The CPR is in effect a fixed, it's a fixed basket. Okay. Now, what the problem with that is that consumption patterns tend to change. Okay. And a fixed CPI won't take that change into account. Moreover, okay, some products get improved, and that takes into account, say, a price increase. For example, again, this is just an example. I'm not saying this is part of the CPI, but let's just say there is a motor vehicle in the CPI, and the manufacturer of that motor vehicle makes dramatic improvements to its product, and of course raises the price. Well, we don't see the improvement in quality in the CPI. All we see is the price increase. So that's just one of the shortcomings of CPI. PCE, okay, is slightly different. It does make, it's a dynamic measure. It does take substitutions, consumption substitutions into account. Moreover, the CPI, it looks at a basket of products that us as households buy. What the PCE do, it's actually a survey that goes to businesses, and it looks at what businesses are actually selling, which helps with the dynamic nature of it. So that's just the differences. Irrespective, there is obviously some sort of clear correlation between the two, which one would expect. Again, the Fed takes the black PCE as its measure, not the CPI, and that's just because of the broad-based dynamic nature of the PCE. Now, with that explanation out of the way, okay, what do we see here? Well, we see a tremendous amount of inflation, okay, whichever measure you prefer. We see a tremendous amount of inflation. Now, let me just take this out, okay, and that's a problem. That's a problem. If we take a look at the statement, okay, the statement that came out of the Fed last Wednesday, actually want to bring it up. Let me just get that for you guys, because there is some really important information there. Okay, so let me bring this across. All right, so you can see here, this is July 27th, the press release here. Federal Reserve issues the FOMC statement. FOMC stands for Federal Open Market Committee. These are the guys that vote on the interest rates. And what we want to see here is this part here. Which, okay, the committee seeks to achieve maximum employment. Well, we're at 3.6%, so we're pretty much okay with this part of the sentence. We're going to get the job numbers on Friday. Of course, we're also going to get the initial claims on Thursday. We'll keep an eye out for that. But now look, seeks to achieve. This is sort of the this is the active part of the sentence. Seeks to achieve. Okay, inflation at a rate of 2%. Okay, that's the objective, right? I think I'm remembering my language structure. Okay, so you've got the seeks to achieve inflation at 2%. Okay, let's go down to the end of the paragraph here. The committee is strongly committed to returning inflation to 2%. This is, it doesn't say the committee is strongly committed to maintaining full employment. Okay, there's no sentence in this statement that says that. It says the committee is strongly committed to returning inflation to its 2% objective. This, I think, is the key. This, I think, is the key. Now, this is an official statement. Now, what happened subsequently is that the press conference was really all over the show. If you take a look at the press conference, I think that whilst the Fed has been, I think, pretty good in its communications, they've started flip-flopping a lot. And that's bad for the markets. So what we got to go to now is this chart here. This 4. We still way over. We're 2.79% points away from the inflation. Okay, so this is a rate of change, by the way. So it's a rate of change. So they want to bring the rate of change down to 2%, and we're at 4.79. So clearly, this has got to be a worry. If you're on the FOMC and this is what you strongly committed to, well, this has got to be a worry. Okay, now that's part one of the sort of observation. Part two of the observation is, well, take a look what's happened to PCE and CPI, okay, at this point here. Okay, what are we looking at here? Let's just get rid of this green. Let's zoom in. We're looking at a kick up in inflation. Okay, so we want to get down to 2%. Okay, with one of these measures, and obviously the 4.79 is the one that we should really focus on. But you've now seen a kick up in inflation. Now, CPI, remember, is a much narrower measurement. It doesn't take into account substitution, which is important when you are measuring inflation. Think about it. If there's good A, good B, good A becomes expensive. Good B is an appropriate substitute, which is cheaper. You switch to buying B. What naturally has to happen to the price of A? It has to come down. Has to come down. Okay, so there's an inbuilt mechanism of inflation control just by consumer choice, which is missing in CPI. But you can see that both of these measures have kicked up. Now, what's interesting here is that the PCE, the rate of change, has been decreasing since February. So if you're a policy member, an FOMC policy member, okay, perhaps you are sighing in relief as you see this coming down. But now it's sort of kicking up. We go back to, we've got to get to this 2%. What's going on here? We're getting this kick up in inflation. Now, this, I think this is the market moving variable that is being mispriced. What do I mean by that? Okay, so if there's any questions about this, let me know, because I'm going to now go to the hidden chart. I'm going to go to the hidden chart behind this. It's important for us just to understand the complexities that we're facing. Okay, so let me figure out how to do this. And I want to go here. Okay, so now I'm going to go down to the 1 hour chart here. Now, what are we looking at here? Well, we're looking at simply the real rates, which is what we introduced yesterday, which I think is has a cause effect. Well, is an effect based on, it should be an effect based on inflation, one would think, right? But let me see if I think I might have to, I'm going to have to reword that. Let's just go back to the 27th. Okay, that's when the here we go. Here we go. So this is now the press conference. So there's some stability, and then they break down. The black line is the 10-year real rate. The 5 is the red is the 5-year real rate. 5 years are actually negative. So we've got negative real rates on the 5-year. We're approaching, yesterday when I looked at this, we were at 7 basis points. We're now at 3 basis points. So the real rate is eroding very quickly on the 10-year. It's already eroded on the 5-year. There's no real rate. Okay. Now, let's just bring up Microsoft Paint. I want to just put some points down so we don't lose sight of these. So the first point is inflation. Okay, and underneath that we can see it's kicking up. Okay, it's kicking up, and it's 2.79% away from target. Okay, I think. All right. Now, the second thing we've got to acknowledge is real rates. Okay, what are real rates? They're eroding. Okay. Now a question I'm going to pose to you guys. We're looking at core inflation here. We're not looking at headlines. So we're taking out all the supply shocks. Okay, we're taking out all the supply shocks. We're only looking at in terms of inflation that is theoretically controllable by the Fed. And again, I think in a stagflationary environment, that might not be the point, but you choose your battles, right? So that's why we looked at core. Now, so we can see that inflation's kicking up. We can see we're 2.79% away from target. So I'll pose the question to you: if you're a policymaker and you are on the FOMC, how do you control demand inflation? How do you control it? And there is only one answer. Okay, there is really only one answer, and that is you tighten policy. Okay, you tighten policy. That's the only thing you can do. You tighten the interest rates, exactly. You have to tighten policy, which is raising interest rates, exactly. Okay, you've got to raise interest rates. And what that effectively does is it effectively suppresses demand. So again, the way that we can think about it, we've all got credit cards. Just assume, we'll make this an extreme example. Just assume that interest rates on your credit card jump tenfold. Of course, it's going to affect your consumption. You're going to consume less, right? Prices have to come down. So that is the only way, okay, that you can really control inflation. Okay. Now, I said that I wanted to correct this sort of statement that the real rates are in effect or determined by inflation. That's not really true, is it? It's actually, it can move in either direction. In other words, if your policy is too loose, which is exactly what it has been in hindsight, you're going to get inflation. Okay, so if your policy is too loose, what's going to happen? Inflation is going to move up. Okay, we'll put this into a formula just now in a moment. Okay, so for all the sort of for all the non-South Africans, by the way, when a South African says just now, okay, it means anytime. Could be now, it could be 10 minutes, could be 10 hours. So when I say we're going to put it into a formula just now, I'm not talking about this instance. As a South African, it could be any time, but we'll put it into a formula, okay? I missed your explanation of where the 2.7. Okay, so we're 2.79% away from target because the explicit target, it's been explicitly stated, is 2%. We want to get to a 2% rate of change here. See that, Rob? And then what do we measure that by? We measure it with what's called core PCE, which is at 4.79. I've deleted it here, but the core PCE at 4.79. So we're away. We took 2.79% higher than target. Does that clear that up? Okay. So now let's just understand. So what happened here? So I've drawn this this blue dashed line. This is the press conference, which actually turns out to be very counterproductive. If you are strongly committed to returning inflation to 2%, well, something happened in that press conference which was completely counterproductive to that. Okay, and they declined. Why am I using 5 years for real rates? Just as an emphasis, Goody. So the 5-year real rate has turned negative, and I'm just showing that the 10 years heading that way. So it's just for an extra emphasis. The point being okay, that there is an erosion of tightening. That's really what I want to highlight. There's an erosion of tightening in the economy. There's no sort of real application in terms of the 5 years. Just to make the point, and you can, just as you and I have been talking, look how the real rates pushed down now to 2 basis points. You see that? Now let's take a look at this in terms of weekly, and you can see here is the real rate coming down quite markedly. Okay, you see the real rate coming down quite markedly. It's actually coming down since the 4th of July, but the press conference seems to have been some sort of catalyst for pushing it down. Now, the big deal around here is let's make it the 10-year. Let's make it the 10-year. Okay. But now you can see something. Look where we are here. In terms, so what are we saying here? We're saying that we have to tighten the economy. We have to tighten the economy, okay? And we were tightening the economy. You can see that we're tightening the economy. This is what we're talking about in contractionary policy to try and control demand side inflation. And that's effectively started, say, in April. Is that, where is 0? Where is 0 here? Let's just get us to 0. Okay, so we started tightening up here. So we got to a really good level, a positive level, here in April. In April, that's tightening. Okay, we're tightening. We've been tightening the economy. Let's just bring up the DAX underneath us. Okay, and the DAX has certainly been under pressure since then. It's actually been under pressure since before then, but really since the real rate went positive, there has been some pressure. All that tightening has been undone. So you've got this green area. That's what we can call tightening. Okay, this over here. This area here, let's change the color. Let's change the color. Let's just make this blue. The blue area is actually loosening. You guys understand the movement up of real rates, we tightening. Movement down of real rates, loosening. What's the problem? The problem is this. We're strongly committed to returning to 2% inflation. But you've just loosened the monetary conditions in the economy. How are you possibly going to get to 2% in a loose environment? If you're 2.79% away from target, how are you going to get to target when you've just loosened conditions? Not possible. It's not possible. If anything, going to fuel the move away from target. And that's a real concern of mine. Okay, that's a real concern. So I feel that there still needs to be tightening. And if there still needs to be tightening, then there's potential pressure that can be applied here. Okay. Let's take it to one extra level. I see there's a few comments. I'm going to come to them in a moment. Let's go to another chart here. Let's take a look at the mortgages. So here's the 30-year mortgage rate. We'll bring it up. So here is tightening. Here is tightening. Okay, so you're trying to get some sort of control over out of control house prices. So what do? You've got to raise interest rates. Okay, there's loosening. Well, if you're loosening mortgages, okay, that's going to, at the very least, support house prices. The worst is going to add upwards pressure on house prices. So this loosening is coming in when we are looking at core inflation, and that core inflation is still out of control. And then we have to come back to, well, what are we being told by the Federal Reserve? We've been told that the committee is strongly committed to returning inflation to 2%. So that's what we've been told. Now, clearly there is a tension between recession and inflation, which is exactly what stagflation is all about. Okay, but we've been told where the Fed's concentrating its efforts, but the market, okay, is focusing on this guy here. It's ignoring this guy here. Okay, so the market's saying, well, the Fed won't be able to pursue its 2% because it's going to start affecting employment. Yeah, we've seen signs of recession. PMIs came in, well, fine, but they're not telling us that. They're telling us that they're strongly committed to inflation. So where's the disconnect? Are we getting told the wrong thing by the Fed or not? If we've been told the correct thing by the Fed, then the pivot, okay, is not to the downside. The pivot's going to be back to the upside. And that means there's a potential dip that we need to keep an eye on. Now, again, this is all supposition, but it's a concern. It's what I was thinking when I saw the DAX hit that resistance yesterday. Let's just take a look at some comments. Did the fact that they raised only 75 instead of 1 full point have something to do with that? No, I don't think it was that. I'll tell you what I think it was in a moment. 75 was already priced in, but a lot of people were talking about 1%. I don't think it was that. Rob saying, I believe in the conference there was a mention that the labor was still strong, but the other economic measures had turned. I understood this to be the catalyst for the rise in risk on. Yes, so what I think was the catalyst, so my opinion is there was two things. First of all, the comment that we are at a neutral rate, it can't be right. We've just seen inflation kick up. So, and I think that was, I don't think there's a, I don't know where that comes from. That looks completely, it looks completely unscripted. I don't see anything in the statement saying about reach. So I think there was a mistake from the Fed chair by saying we're at a neutral rate of unemployment, okay, which is, and then what he said was he basically said we're going to slow down in terms of our rate increases, which is okay. But when you're trying to control spiraling inflation, expectations are everything. Expectations in the market are everything, okay? So if you expect a slowdown in interest rate hikes, you'll act appropriately. Now, you've got to, if you're playing sort of poker, high stakes poker, you know, you keep your hand close to your chest, right? reveal, but you try not to give away tells. So it's almost that there was a reveal, and once that reveal was made, the real rates just tanked. So in a matter of 3 or 4 sentences, the market just went from loose to ultra loose. When you're trying to be ultra tight, it was a tell. So that's what I think happened there, Rob. I think that he went off script, and it just was, in my opinion, really damaging for what these guys are trying to do. They're trying to get back to 2% inflation. Well, they've got to start from the beginning. But how do you start from the beginning in such a complex environment? It's in my opinion, a serious policy error that's been made here. I'm not sure if I'm overreacting to it. And now that I think about it, how do you recover from that? And that's why I think we're in such a difficult environment. And it's asking, what do we mean neutral? So neutral is basically where there is no pressure on your demand. So neutral rate, and by the way, is theoretical. You'll never get an actual number. The neutral rates are going to be debated amongst economists on an academic level, but neutral is at least a target to aspire to. So if you think that your interest rate, if you think that your economy, where you can start controlling inflation without really damaging your economic activity, is 3%, and 3% is kind of neutral. So if you go past neutral, then you are tightening. If you're below neutral, then you are loosening, right? So if we're at neutral now, then so be it. But we can't be at neutral, not yet. We've just seen we're in the midst of out of control core inflation, which has just kicked up. So that, I think, was one sentence that the market just kind of went on this massive binge party on. And then the other thing is when he said, well, we're going to slow down our rate of change, now that could be the case, but in a time when you're trying to curtail potential spiraling of inflation, you can't let that tail go. Let's just bring up yes, what did he mean? I think he was, to be honest, I don't think he meant anything. I think he was flustered by the press questions, Anna. I think he made an error. I think it was an error. I don't think he meant it in the least. He can't possibly have meant it in the least because it's just not possible. I'll show you mathematically why it can't be possible in a moment. Let's do that now, actually. So we'll just go back to our time value of money. Present price. Just this present price equals, let's call this cash flows. One plus interest. Okay. Right. So we're going to just use the time value of money in a slightly different way. So present prices are high. Present prices are high. This is our inflation component of this equation. So you want to control this. Okay. So how do you control it? Well, you've got to make it come down. Okay. Well, you control it by increasing interest rate, not decreasing interest rate. Bang. Schoolboy error. Now that's exactly what's happened. Okay. Let's just take a look. A few more comments, and then we better do some analysis. Anna's just writing, just read this earlier. Many economists are puzzled. Bill Dudley, a former central banker, says markets are underestimating just how far the Fed will go to tame inflation. So just it, my opinion on that. So this is where it gets even more complex, Anna. Okay, because the market is thinking that this is, so the Fed is saying we're going to get inflation under control. The market's saying, no, you're not. You're going to focus on the your other mandate. Clearly, there's a disconnect here. So, yes, Bill Dudley is right in assuming this is what they're going to concentrate on. If they switch to this side of their, then maybe they're not. But they're telling us this is what they're focusing on. So then they must be underestimating just how far the Fed will go. They must be. Okay. That is, I think, the whole point. Now, if that is the case, then as traders, that makes huge, makes a huge impact on us. I was going to bring up some web page. I completely forgot which one it was. So if anyone wants to remind me, but in the meantime, let's just go and take a look at the Nasdaq. So, because the point is, Katie, this fits in exactly with a Nasdaq analysis. Okay, so let's go back to our real rate. Okay, so let's just go back to the real rate. Okay. Yeah, and just reading the end of Anna's note that she sent me. So she's quoting an article, and it just the last sentence says, given all the hawkishness, what explains the market? The assumption is investors are betting on Powell is going to pivot. But he can't pivot if this is their objective. That's the whole point. It's impossible to pivot if you want to reach this 2%. Either you're going to have to increase this 2% as a target, or you can't pivot. And if you can't pivot, then it comes down to, okay, this real rate analysis. Let's just get this as a, okay, which feeds in now to the Nasdaq analysis that we're going to do. So we just bring up the Nasdaq. Okay, and what you can see here is, let's clean this up. All right, so what we can see here is a correlation this way, correlation this way. Okay, now look here, Katie. Here is the real rate coming down. There's the real rate coming down. Here is Nasdaq responding to that real rate coming down, which makes sense because, as we've mentioned many times, the growth side of the market, which is exactly what Nasdaq represents, is very sensitive to interest rate movements. Now, what this means for us, if there is going to be that Powell pivot, and we do see that this moving down, then we will see Nasdaq moving up. Okay. Now, if the market is incorrect, then the pivot actually goes this way. And if the pivot goes this way, well, then I think we can make the argument that Nasdaq will go that way because of its relationship to interest rates in the time value of money. So this is, I think, the complexity that we're facing as traders. It makes it very difficult to actually come up with some sort of sensible position because there is a tug of war going on between the market and the Fed at the moment. Inevitably, one of them are going to win out. Okay, inevitably. So I think that, first of all, Chair Powell made serious errors on Wednesday. That's just my opinion. He couldn't possibly have meant we're at neutral. couldn't possibly, because we've just seen on the time value of money, if we're trying to control inflation, which is now at 4.79%, okay, well, loosening, it's not going to really, loosening via your expectation, but fostering expectation, not the way to do it. So this over here now becomes a very interesting dynamic. If it plays out, because again, I don't know if this is the way it's going to play out. This is what makes sense to me. Okay, what makes sense to me, but we don't want to forecast. Yeah, it's very difficult to trade in this environment, and I think that's as far as we can really go in terms of acknowledging. Then the 62% retracement perhaps has much more force behind it than I thought yesterday. Then it probably has much more force behind it. Go to the daily. Well, then if we break below zone 1 into zone 2, that's a big deal. If we maintain in zone 1, then maybe there is that power pivot. But if there's this power pivot, Anna, just I think an obvious statement to make. If the Fed pivots, okay, to a dovish stance, then inflation's entrenched. And that's going to be a whole new saga that policymakers are going to have to deal with. So that's why I don't think they can pivot, by the way. They exist purely to control inflation, price stability. You can't let that get out of control. So a movement from zone 1 to zone 2, I think, would be meaningful. But it's so difficult, okay, to get our heads around that, given how positive July was. But when we go to the weekly, or maybe it's a dead cat bounce. Let's go to the Nasdaq here, just to round off the analysis here. Okay. All right, so let's do a similar analysis here. Let's get a fib in. Okay. So here's the 62. We're still quite far from it. All right, let's put in some price resistance. So here is the principle of polarity. So in terms of the polarity principle, polarity just means support turning into resistance. So then we're at the point of polarity, right? If we're at the point of polarity, well, we can put in LP question mark, okay? And if we can put in LP question mark, go down to the daily, then of course, the key would be moving from zone 1 to zone 2. We're not there yet, okay? So let's be very clear. I'm not predicting a fall in zone 1 to zone 2. I don't know if that's going to happen. What I'm saying is, if there is a Fed pivot to dovishness, I think the 62% gets surpassed easily. If the Fed cannot pivot, if it has to fight inflation tooth and nail, there has to be some sort of applied pressure on present value, values, which means that the lower peak question mark becomes an acceptable theory. And I think to round this all off, and this is where we'll end, is let's take a look at COPOC again, and let's take a look at yield curve inversions, because we didn't look at yield curve inversions yesterday. Let's just bring up Nasdaq. See, that's I think a good example. So we'll bring in Nasdaq here. Let's make this monthly. All right, let's bring in COPOC. All right, and we did note that we are below 0, which is, I think, a good thing. I think below 0 is a good thing because that is a requirement for a buy signal. But that's, remember, one of two. Let's add in that 3-period EMA. And so we've only got one of two. Two of two would be Copac taking out this EMA or just turning up. We really just need to set turn up, but putting in the signal line might make it a bit clearer. So if we don't have the power pivot, and if we see that they fight tooth and nail to return inflation to 2%, well then Nasdaq potentially falls further, and we only set turn up lower down. So we've only got 1 out of 2 conditions. We've got 1 out of 2 conditions. So I think that's something we must acknowledge. Yes, we're getting to that value stage, but we're not out of the woods yet. We're not out of danger. Why aren't we out of danger? And I think this is where we can end this webinar, is we just take a look at the 210s yield curve. So let's just bring that in. Let's just take it off logarithmic. And you can see we actually are in serious inversion here. So this is 2008. This is global financial crisis. This is tech wreck. So we're kind of in that territory. Now, the deeper we go, the more serious the inversion. Okay, and I think what we've got to do is account. So if we kind of spark up out of 0, okay, fine, then we only spend 4 weeks down. But if we spend 8 weeks, 10 weeks here, then I think recession's coming. Now, what does that mean? If recession's coming, well, one would expect maybe that potentially is a manufactured recession. If it's a manufactured recession, then Fed is fighting tooth and nail to get us back down to 2%. If that's the case, then you know, the bullishness that sort of is pervasive in the market at the moment might be actually a dead cat bounce, might be opportunity there, and that's what we're going to watch for. I know we said we're going to end here, but just this last comment by Rob has to be mentioned as well. The other part of the puzzle is the Fed hasn't started QT yet. It has started QT, but it hasn't normalized this QT. So let's just bring up a Fed balance sheet here. So it's going to take 3 months of sort of gradually building up to, I think it was about 95 billion tightening per month coming in September. By September we should have normalized the full process. 60 from treasuries, 35 I think from mortgage-backed securities. I think this is the one we're looking for. Let's just see if this is it. No, it's not that one. Yeah, here we go. Okay. So this is the Fed balance sheet. So there has been some elements of tightening here, but you're quite right, Rob. In terms of where it's actually going, yeah, we haven't got there. We haven't got there. This is going to the tightening is going to accelerate and then stabilize into September. And what we can do here, let's keep this on weekly. All right, what we can do here, let's just add a simple moving average. And we'll do let's add a 13-week. So we get a 3-month simple moving average here. I think this is it. Yeah, this is it. Okay, so you can see we now underneath this simple moving average. Take a look at that moving average. It's starting to slope downwards. So yeah, quite right there. You know, into September, this makes conditions worse. Now, this is the whole point. They're looking to tighten, but they've loosened. We're back to interest rates that we saw in April. There's something odd there. Yeah, so just reading it, Anna saying the stated objective to continue reducing it slowly. Okay, so we'll just see how this transpires. But by September, the previous communication, or the last that I read, is they're looking to get it to 95 billion per month in terms of asset sales. Is there anything else? I think that's everything. We can, any questions? I think we can see that the markets are complex, and the Fed, I think, is flip-flopping. All right, guys. Now, thank you, Katie. Let's wrap up here. We'll let's meet up again tomorrow. Tomorrow we'll have a shortened morning market review, but then we'll move over to the crypto minute. Thanks very much, guys, and chat to you all tomorrow. Have a great day ahead.